Okay, so this is going to be my summary for Unit 17. So Unit 17, I guess, is different to all of the others because we're not introducing sort of a new model or a new way of thinking about things, but really just trying to use the models that we've had in the previous units to analyze and explain economic history over the course of the 20th century and into the 21st century. So we look at various different sort of epochs. We're going to look at the Great Depression and then the Golden Age and then stagflation and the Great Moderation and the recession. And what we're going to try and do is use the different models that we've kind of come across in previous units to explain what's going on in these different periods of time. So starting with the Great Depression. So just looking at some data, we see that the kind of beginning of the Great Depression is in 1929 when there is this big stock market crash. And the first kind of really clear effect of this is we see over the next few years, unemployment drastically is increasing, right? The employment rate is really shooting up. And it does come back down over time, but really doesn't fall back down to a relatively low level until the Second World War. Now, some other things to note that happen, and some of these things are going to be mentioned again. So industrial production immediately kind of starts to drop off in this period of time, which probably correlates quite well with unemployment going up. Less production means fewer workers required. But a couple of other things that are important. So this line here, that's real GDP. So obviously we have a recession because GDP is falling. And another key thing is this, the price level. Consumer prices start to fall. So actually the Great Depression marks it's a deflationary period of time. And that's going to be really, really crucial. So first overall thing, what kind of crisis, what explains why we had the Great Depression? So obviously there's going to be lots of disagreement and different thoughts on this, but ultimately I think we believe that this was due to a crisis of aggregate demand. That there was, from the stock crash onwards, a reduction in aggregate demand, and the government didn't really step in until much later on to try and have an impact on that. So what were the drivers of this? Well, we kind of think about there being three positive feedback mechanisms that really drove the Great Depression. And so positive feedback mechanism, that's when we're at an equilibrium, and then there's some sort of change away from the equilibrium, and that change drives a further change to take us even further from equilibrium. And so kind of things getting, in this case, worse and worse and worse. So what were the three drivers? Well, the first was just this pessimism about the future. All right, the stock market crashed, people started losing their jobs, so people's expectations of their future employment and future earnings dropped. They were pessimistic because the value of the assets that they owned had dropped. And that pessimism about their future earnings and things, we'll see how we can use a model to imagine this in a minute, but that certainly led to people then saving more and certainly reducing their consumption, so therefore decreasing aggregate demand further. Second thing that drove this negativity was the banking system at the time. Lots and lots of banks in the US, and this is mainly going to be US focused, lots of banks failed. They went bankrupt. And the ones that remained did something that was really unhelpful. They increased interest rates. Now, they did that because they were worried about the risk of lending, because they saw people's incomes falling. But that would be another knock-on effect, because we know that higher interest rates, that's going to kind of encourage more saving and therefore discourage consumption, but also discourage investment. So this really didn't help things either. And the final thing is deflation. So why does this kind of drive aggregate demand even further down? Well, because deflation means prices falling. Falling prices might make people then delay their consumption, right? If you see that prices over time are coming down and you're thinking about buying some big item, then you're going to think, well, let me wait. And so prices falling led people to delay their consumption, but that further reduced aggregate demand. And in fact, it fulfilled prophecy that led to prices falling even further. So these three things were really at the heart of kind of pushing aggregate demand even further and further and further down over time. So what was government's response? Well, we can actually see from this data here, and let's jump to 1929 to 1933. This gives us maybe the first indication of what the government's response was. So first of all, we can see really negative, like real negative change in household and business investment, but also in terms of consumption. And in terms of government response, the one indicator we have here is government purchases, and we see it tiny, all right, absolutely tiny. And be careful though that government purchases, government spending wouldn't capture everything to do with fiscal policy. For example, if the government cut taxes or increased, say, the size of transfer payments, that would actually have an impact on consumption, right? That's where we measure those things, that although the government gives those things to households, we see it in these statistics in terms of consumption. But certainly looking at government purchases at this time, almost like nothing, right? Very small. And this is because the Hoover administration, who were in charge up until around this time, they thought that the key to solving this problem was to be really sensible and sensible about government finances, to balance the budget, and not to really step in terms of trying to drive any demand. And it's only when we see the Roosevelt administration take over that this begins to change, right? We could see increases in consumption and household and business investment. That might be as a result of some fiscal stimulus, but we also see higher government purchases. And these are the changes. So this is like a big change, a big positive, a big increase in government purchases, which indicates that there's maybe some sort of stimulus going on. And as we look at the future periods, we kind of see these government purchases are still there, still like positive. So even bigger government purchases than in the previous period. And I suppose it's not really until here, the build up to the Second World War, that we see a really big increase in government purchases. One thing to point out here is actually 1937-38, we actually have another recession again. And that's probably because at this point, there was pressure on the Roosevelt administration to tighten interest rates, to lower government spending, because people were concerned about the budget. And actually, this probably spurred a bit of a recession over the course of that year. So another way of looking at why there was this depression is to think about the household perspective. And we've seen these models before where we look at kind of household wealth, broad wealth. And so this is how we can imagine things changed over the course of sort of the Great Depression. So early 1929, before anything kicks in, households' total broad wealth is equal to their target for broad wealth, right? Which means, everything's going along smoothly, no extra saving or no extra consumption happening. But then the Great Depression kicks in, and watch what happens. People's expectations of future earnings drop. Their level of financial wealth falls as well because assets have lost value. Home equity has gone down because the value of people's homes went down. And now you can see there's a big gap between the actual broad wealth the average household had and the target. And what happens in those circumstances? Households will try and increase their savings. They'll reduce consumption to try and get back up to that broad wealth. And reduced consumption, we know, means a cut in aggregate demand. And then we see a kind of recovery period. So late 1933, maybe people are feeling more positive because they're seeing the government stepping in. And so expectations of future earnings go up. Financial wealth recovered a bit, home equities recovered a bit. And in fact, now we're actually at a place where total wealth is above the target. And so we might actually see some reduction in savings, increased consumption, and that will boost aggregate demand. So what actually happened in terms of policy? Well, some of the stuff I've already mentioned. In terms of fiscal policy, really not that much, actually, until World War II. Now, the Roosevelt administration did introduce lots more government spending compared to previous administrations, but actually it really didn't become sizable until World War II, until the kind of build-up of the military. And then I mentioned 1937, there was a bit of tightening. So let me skip down here. So what were some of the things that the Roosevelt administration did? So the New Deal, what did they actually do? Well, they did increase government spending, right? And increased the size of government to a size that hadn't really been seen before. And that had a big impact, particularly after the Second World War. They left the gold standard, which I'll talk more about in a second, and also very importantly, reformed the banking system to make it much more difficult for banks to get into a position where they would go bankrupt. And so that kind of added confidence to businesses and to households. So let's come back to the gold standard, because we would think once the Roosevelt administration comes in, we think that they want to use monetary policy as well as fiscal policy to try and boost aggregate demand, but they were constrained a little bit. And one thing that was constraining them was the fact that there was deflation. So because there was deflation, and let me quickly write down an equation that we've seen before, which is that the real, and I'll call it real R, the real interest rate is equal to the nominal interest rate, I'll call nominal R, minus the inflation rate. So from a government perspective or from a central bank perspective, when there's a decrease in aggregate demand, what's the typical response? Well, it's to cut the nominal interest rate, right? So that the real interest rate falls, and that encourages borrowing, discourages saving. So maybe there'll be more consumption and more investment. But if there's deflation, then this bit of the equation is actually negative. So minus and minus, this actually then becomes a plus. And so the real interest rate is actually higher than the nominal interest rate. And so even though there was some cutting of the nominal interest rate, because the nominal interest rate was being cut less than deflation was, when prices were falling, this actually meant that the real interest rate was actually increasing. And this is obviously not what was intended, right? They don't want the real interest rate to increase because that's going to further discourage borrowing and encourage saving. So this was one element of the problem, that having deflation was kind of preventing the cut in nominal interest rates having the effect that they intended. Now, the gold standard, that was another problem. So what the gold standard meant was that the US was committed to exchanging a certain number of dollars for 1 ounce of gold. It's roughly about $20, $21. So why is this problematic? Well, the US were keen not to kind of see their gold reserves fall in value. And that would happen if foreign consumers wanted to get rid of their dollars and exchange those dollars for gold. Now, why would foreign consumers want to get rid of their dollars? Well, maybe they saw weaknesses in the US economy and so thought the dollar's not safe. Let me turn my dollars into gold instead, because gold is much safer. So how could the US respond to this to encourage people to hold on to dollars? One way would be to try to encourage greater levels of exports. But that's tricky. And that's something that might take time, right? To improve the competitiveness of US exports, that might take a bit of time. So instead, what the US did was to keep its nominal interest rate maybe a little bit above nominal interest rates in other countries, because that would encourage foreign savers to try and save in terms of dollars. And if foreign savers wanted to save in terms of dollars, that means they need to hold on to their dollars and not convert those dollars into gold. But obviously, that was problematic, right? Because then that prevented the US from cutting the nominal interest rate as low as they wanted to, because they didn't want to run down their gold reserves. And so that gold standard was really causing a problem. So the combination of gold standard and deflation prevented nominal interest rate being cut as much as it needed to. So that's a kind of, I guess, summary of the first period of time, the Great Depression, and why fiscal policy kind of started to kick in, why monetary policy was constrained. But these steps, the New Deal, some of the things that were brought in, particularly increased government spending, that then really set up what was referred to and what is referred to as the golden age of capitalism after the Second World War. And that's what I'll go on to talk about in a minute after a short pause. Okay, so carrying on. So some of the steps taken during the Great Depression and after the Second World War led to what we refer to as a golden age of capitalism. So just to recap some of those steps before we have a look at interpreting this in terms of the labor market. So in most countries, and particularly in the US, there was now this increased commitment, or a commitment to an increased size of government, right? There's the introduction of unemployment benefit, and certainly lots of other kind of welfare state programs, social security, health insurance, those kind of things. But there was also now mechanisms in place to try and automatically respond to a kind of aggregate demand crisis, right? Unemployment benefit being a perfect example. So if aggregate demand fell in the future and unemployment rose, unemployment benefit kicks in and stabilizes things because it replaces the lost income for those unemployed people. And another kind of mechanism that helped stabilize things if there was an aggregate demand problem was the introduction or the kind of Bretton Woods agreements. Now, what this did was it tied exchange rates to the US dollar as opposed to like having the gold standard. And it also meant that countries could devalue their currency if they faced a balance of payments problem. So these two things here really made it so that aggregate demand could be easily, well, not easily, but could be stabilized more easily than before the Second World War. So all of this, one particular thing to pick out when it comes to the labor market is unemployment benefit and elements of a welfare state, right? If we think about what that's going to do to the wage setting curve, so the wage setting curve shows us the wages that workers would demand in order to put in effort at every level of unemployment. Well, with unemployment benefit in place, with other welfare, social welfare systems in place, workers are going to feel a lot more confident in terms of bargaining for higher wages. And so if we draw on for comparison, here's the wage setting curve for the early 1950s. Let's imagine that this is probably where it was for the 1930s or 1920s. Certainly much, much lower, because there wasn't this unemployment benefit, there wasn't this strength of bargaining power. And something else maybe that added to the bargaining power was that union membership really started to shoot up after the Second World War. The percentage of workers who were part of a union was getting much, much higher. And again, that gave workers more bargaining power, so certainly shifted up their wage setting curve. So that's kind of things from a worker perspective. We can also then think about, well, what was going on in terms of employers? And the employers saw labor productivity really increase. Why? Well, lots of technological innovations after the Second World, or kind of that had been produced during the Second World War, now came into use widely. Lots of people who served in the military had come back and gone to university, and so a more educated workforce. And so what did this mean for firms? Well, the higher productivity meant that they could achieve higher after-tax profits, and that led them to invest more, and that led to further technological progress and like higher productivity, and that meant even further job creation and just overall lower levels of unemployment. Now, firms were able to maintain this sort of flow because they were able to maintain relatively high profits. And a big part of this was this post-war accord that, although workers had increased bargaining power, and there were unions getting involved, the unions refrained from using their full bargaining power, right? They kind of recognized that in order to kind of keep things going as they had been, to kind of achieve technological progress, which would increase productivity, which would lead to lower long-run unemployment, they kind of bargained for maybe higher wages, but accepted wages, or accepted that firms still needed to make profits, and enough profits so that employers could keep investing to keep unemployment low. And so that's what we mean by this post-war accord, that the pie overall is getting bigger, right? Because labor productivity is increasing, the value of workers' output is increasing, and that increased value was being split, sort of evenly between higher wages for workers and on retained profits for the firms, who could then use that for investment. And that increased investment just kept the productivity going up and up and up. And so what we can maybe imagine is happening over time is that, okay, we know that the real wage, seen this so many times now, is equal to lambda times 1 minus mu. So we're imagining that lambda, the productivity of workers, is increasing. That's going to push our price setting curve higher and higher up. But we can also imagine over time that the wage setting curve is also sort of shifting upwards. And let me make sure I get this in maybe the right place. So yeah, we can imagine our price setting curve is shifted upwards, our wage setting curve is shifting upwards. And what is that leading to over time? Well, it's leading to higher real wages for workers and lower levels of unemployment, right? So everybody seems to be winning here. The firms are maintaining high enough profits to keep on investing. The workers are seeing wage increases and we're seeing falls in unemployment. And this is really why this is referred to as the golden age of capitalism, because for this period of time, post Second World War, up until the late 60s, early 70s, this is what we see, this is what we saw happening: increasing real wages, lower and lower levels of unemployment, and everybody seems to be happy. And then it does come to an end. So the end of the golden age, there are a few different things that led to it. But before I get into that, again, I'm just going to take a quick pause. Right, so picking up, what ended the golden age? Well, a couple of big things. The first, let's think about things from the firm's side. So profit levels, well, there's kind of a couple of things going on at the same time. And in fact, let me actually start with the worker side. So workers had seen low levels of unemployment for quite a long time, right? And they'd also seen governments committing to providing greater and greater protection for them. And as a result, workers kept on demanding further and further improvements. And what we see in the diagram here is that the wage setting curve, kind of in the late 60s and early 70s, is higher than it was earlier. As we expect, if workers are demanding more, they're feeling more secure in their jobs, wage setting curve is going to shift upwards. So that led to the profit rate of firms being driven down. Why? Well, because this increased demand from workers decreased the amount of profit that firms were making, and that led to lower levels of investment, and lower levels of investment led to the rate of productivity growth slowing. So that increase in lambda, there was still an increase, but it was getting slower and slower and slower, and it wasn't going up as fast as demands from workers. So the combination of all these things, right, plus one other really, really big event, which is oil price shocks, right? In the early 1970s, there is a shock to the oil price, right? So we see kind of a war in the Middle East that reduces the supply of oil. So sudden increase in the price of oil, which is a massive input to lots of different firms. So the combination of slowing productivity growth, increased demands from workers for higher wages, and these oil price shocks, all of this came together to mean that the pie stopped getting bigger at the same rate. Workers were demanding a big share of the pie, and this whole post-war accord collapses, right? And what does that do in terms of the labor market? Well, so let's go up and think about what's going to happen. So first thing is, we have what I mentioned before: increased demands for workers. Wage setting curve has shifted upwards, right? From the late 50s to mid 60s into the late 60s and early 70s, wage setting curve shifted upwards. Now, let's sort of ignore the slowing productivity growth for a second, right? Because productivity growth would mean that the price setting curve shifting upwards, but we're kind of imagining, let's kind of ignore that, imagine that there's just sort of none. And then the other key thing that happens is the price setting curve will actually shift downwards. Why is that? Well, remember that the real wage level, the profit maximizing real wage W, depends on the nominal wage and the price level. And the price level starts to increase because of these oil price shocks, right? If the price of oil goes up, and that's a big input to lots and lots of firms, then what are they going to have to do in response? Well, to maintain the same markup, and we're imagining they can do that because maybe the demand for their products hasn't changed, increased prices, increased cost of production for them will just get passed on into increased prices for the goods that they're selling. And so the price level goes up. And if the nominal wage doesn't rise, then that is going to push the real wage down. So, okay, what's this going to mean? Well, now we have the real wage that firms can afford to pay or willing to pay down here. We have the real wage that workers are demanding up here. We now have a absolutely huge bargaining gap, right? This whole gap here represents a bargaining gap, the difference between what workers are demanding and what firms are willing to pay. And as we've seen in previous units, what's this going to do? Well, firms want to get their workers to put in effort. So what are they going to have to do? They're going to have to increase nominal wages by the size of the bargaining gap plus any expected inflation. But then we know that after the HR department has done that, the production department will just pass on that increased nominal wage, that increased unit cost, again, in terms of increased prices. And so people are going to see inflation. And just to bring in the Phillips curve for a second. So if we've got, say, the inflation rate and employment N over here, let's imagine there's our initial Phillips curve. And maybe at the equilibrium level of 4% unemployment, people were expecting, I don't know, let's imagine 3% inflation. Then when this bargaining gap kind of appears, right, what's actually going to happen? What actual level of inflation are we going to see? We're going to see a much higher level of inflation. We're going to see that 3% plus whatever the bargaining gap is. And so we're going to get a much, much higher level of inflation. But if unemployment is maintained where it is, then what's going to happen is we're going to get a shift to a new Phillips curve. So expectations are going to change. People are now going to expect higher levels of inflation, whatever they saw in the previous period, which would have been the expected inflation in the previous period plus the bargaining gap. And that's going to move us now to a new Phillips curve. And if that bargaining gap doesn't close, we are going to keep on moving to higher and higher Phillips curves, right? And so inflation is just rising and rising and rising. And if eventually the bargaining gap is allowed to close and we move to the new equilibrium, which would be, so here's our wage setting curve, here's our price wage setting curve, and here's our new price setting curve. You can see this is going to be a much, much higher level of unemployment. So a combination of all these things, kind of moving to new Phillips curve, so rising inflation, and then eventually we move to a new equilibrium in the labor market with higher unemployment. And so what do we see? Both high unemployment and high inflation, which was what was referred to as stagflation. And this is what was seen throughout the 1970s and even into the 1980s. And this pretty much put an end to the golden age of capitalism. So where do we go from there? Well, governments needed to respond to try to put an end to the bargaining gap, to try to put an end to rising inflation. And what we're going to look at is so through supply side reforms. And these are generally associated with the Reagan administration in the US, the Thatcher administration in the UK. And what both countries did was put in place much more restrictive monetary and fiscal policy. So the monetary side, very high interest rates. So the chairman of the Federal Reserve at this time, Paul Volcker, he put in place interest rates which were in like double digits, 12, 13%, and also stressed that he was aiming for lower inflation. He was targeting inflation. On the fiscal policy side, there were cuts in unemployment benefit, and also this sort of relaxation of the commitment to full employment. Right? There used to be, in the golden age, there was a commitment to trying to have full employment, whereas the Reagan and Thatcher administrations kind of signaled very clearly that they were happy to allow higher levels of unemployment. So allowing higher levels of unemployment, higher interest rates, cuts in unemployment benefit, and also attempts to reduce the power of trade unions. All of these things combined, I say, to close the bargaining gap. Why to close the bargaining gap? Because they would have shifted this wage setting curve back down and moved us back to, say, this equilibrium here and get rid of that bargaining gap. So that is how we think stagflation was really brought to an end, was through this combination of different policies that closed this bargaining gap and therefore put an end to rising inflation. However, some of these policies then actually set the scene or set up the next crisis, which is the financial crisis. That's what I'll go on to talk about in a second after a short pause. Okay, so what we see in this graph, and what's quite helpful about it, is we can see from end of the Second World War, 1949, up until the mid-1970s, there is this really strong link between increases in productivity and increases in real wages, right? Showing us that as the output per worker, the value of the output per worker went up, workers' real wages went up as well. But then from the mid-1970s onwards, we see a big kind of divergence, right? So productivity rises, and actually we see really big increase in productivity, and yet real wages stay relatively stagnant. So what does that tell us? Well, productivity is the value of or tells us the value of the output per worker. And real wages tells us what's the share of that value that workers are getting. So if productivity is rising, but real wages are staying stagnant, that means the value of the output must be going somewhere else. And who is it going to? The owners of firms. And there certainly are a smaller number of owners of firms than there are workers. So this kind of tells us there must be increasing inequality. So this graph shows us rising inequality. It shows us that the profit rates after tax must have been increasing. But what also happened at this time is we'd see the link between investment and profits start to get weaker. And that kind of indicates that firms are not reinvesting those profits to try and increase productivity further, that potentially they're holding on to those profits, maybe giving them out as dividends or investing in other, I should say investing, or buying other financial assets, but certainly not reinvesting in their business. And the consequence of this is the growth in the capital stock was declining. And remember that we said one of the essential elements for innovation to happen is we need to accumulate more and more capital. So here we see real issues in terms of improving long-run productivity. Like the mechanism for that to happen has started to go wrong. But the rising inequality also causes a problem. So before we kind of jump into the problems that this all caused, now let's talk about the period that comes after stagflation has ended, which is referred to as the Great Moderation. And just to talk briefly about some characteristics of the Great Moderation. So we started to see low levels of inflation as a result of the inflation targeting and independence of central banks, and those levels of inflation were staying relatively stable. At the same time, we also saw unemployment falling, right? Falling from quite high levels in the late 70s and 1980s to much lower levels in the 1990s and the 2000s. So this, why is it called the Great Moderation? Because we were seeing things become less volatile and much more seemed like the combination of fiscal policy and monetary policy had made the economy, made the business less. But what was going on in the background was, because of the inequality, the rising inequality, households needed to borrow more if they wanted to finance big purchases, say like houses or cars. And also within the financial sector, we also saw a lot more borrowing, a lot more debt. So much higher levels of debt in both of these sectors than had ever been seen before. And one consequence of the rising household debt was an increase in house prices. And I suppose this point here, rising inequality, we saw that earlier on, but that meant that increase in consumption a household wanted to have needed to be funded loans. And that kind of comes back to this rising household debt. So housing is the key aspect of what caused the financial crisis. And we'll talk about how using some of our boom bust models in a second. But one other set of policies that were brought in by the kind of Thatcher and Reagan administrations and other administrations around the world was deregulation, right? Removing some of the costs of doing business, some of the bureaucracy, some of the regulation. And this in particular, particularly important for the financial crisis, happened in the financial sector. So the kind of combination of financial deregulation and rising house prices, from commercial and investment banks' perspectives, they then started to extend more loans for housing and also for other consumer durables, cars, furniture. So banks started to loan out a lot more, but they also started to buy more financial assets, and financial assets in particular that were based on bundles of home loans. So home loans got kind of grouped together into a big bundle with some kind of maybe more risky home loans, some less risky. And people bought these as an asset, kind of with the thought that very few people default on their mortgage payments. And as a result, this is sort of like a guaranteed return, right? Even if one or two people in this package of mortgages default, the vast majority won't. So this is relatively low risk. And some of these financial assets had names like collateralized debt obligations or mortgage-backed securities. And commercial banks and investment banks were buying more and more of these assets because they thought they were really safe. So combination of all of this meant that banks were seeing increased leverage ratios. And we know that higher leverage ratios puts them at greater risk of insolvency. But there was kind of a confidence that all this was based on a housing market, that housing was very solid, very dependable, not risky. And so this was all fine. And what gave this a lot more credibility was credit rating agencies. So these organizations their purpose is to look at financial assets and to award them a sort of rating, like AAA, AA. Credit rating agencies were giving really high ratings to these financial assets based on bundles of home loans, even if those assets were composed of subprime mortgages, right? Remember, subprime means a mortgage or potentially a loan that's given to someone who is a high risk of default, maybe doesn't have very much collateral. So even if these financial assets were made up of lots of subprime mortgages, credit rating agencies were still giving them high ratings. And so this kind of kept everyone believing that the risk was minimal and everything was fine. So this obviously came to an end when people, particularly in the US, these subprime mortgage borrowers, when they started to default on their mortgages. Because as they started to default on their mortgages, these financial assets that were built on these mortgages started to lose value. And this caused a bit of a panic. Now, before I go further into the details of that, I want to talk a bit about kind of how we can have a housing boom and bust. Before I do, I'm just going to take a quick pause. Okay, so just to kind of go away from the financial crisis for a second, I'm going to talk through some of the ways we can think about how housing as a market could be one where you see bubbles and see busts. And these diagrams kind of start us off, giving an indication of why this might be the case. So if there's been some sort of boom, some sort of increase in house prices, and this happened in the US probably because the kind of government wanted to encourage further home ownership. And so kind of helped to boost demand for houses and then prices. That means individuals who own houses or have some equity in houses, the value of the collateral that they have for a potential loan goes up. And that means they might feel more comfortable about borrowing higher amounts of money. And maybe that extra borrowing could then go towards the purchase of a bigger house. And therefore the demand for houses goes up, and that's going to push the price of houses up, and so on and so on and so on. And you can see the diagram on the right just shows us the opposite, right? If house prices start to fall, the value of the collateral you can bring loan falls, so the amount you can borrow falls, and therefore the number of people who would be willing and able to buy houses starts to fall, and that then means further house price declines. So this is one way of picturing what kind of put an end to the housing bubble. Another way is to think about price dynamics curves. And this is just a reminder of how price dynamics curves kind of, we think they work in general. So the diagram on the left, let's imagine that at the moment, the price of a particular house is P0. And what the price dynamics curve, this blue curve, shows us is, okay, so if the price is P0 today, the price tomorrow will be P0. So then we fast forward to tomorrow and the price is P0. So the price the next day will be P0. And so as long as the price is P0, it stays there, okay? Stable, it will stay there. But if there's some sort of shock that moves the price up to P1 today, then what this price dynamics curve shows us is that tomorrow, right, price P1 today, go up to our dynamics curve, and actually we're going to be at a price tomorrow that's higher than P1. And in fact, we're going to be at a price tomorrow of P2. And if the price is P2 tomorrow, then the next day it's going to be even higher. And so this price dynamics curve shows us if we get a bit of a shock to the price, we're going to keep going away further and further and further and further away. And so the price will just keep on increasing and increasing and increasing. This one, on the other hand, shows us, so that's an unstable equilibrium. This one shows us a stable equilibrium. So again, if we imagine that the price today is P0, so go up to our blue curve, our price dynamics curve, and then the price tomorrow is P0. So P0 is like an equilibrium, okay? If the price is at P0, it's going to stay there. But for this model, if there's a shock, if we get a shock and the price increases to P1, well, this price dynamics curve, this shallower one, shows us, well, if the price is P1 today, after the shock, then tomorrow it's going to be P2. Now, P2 is actually less than P1, right? And so the next day, we're at P2, and the price dynamics curve shows us if we're at P2, then the day after, we're going to be at a price lower than P2. And so how it's happening here is the price is kind of returning and getting closer and closer and closer back to P0. So this shows us a stable equilibrium because it shows us that if we get a bit of a shock, we'll move back to the equilibrium level. This one, unstable, because if we get a bit of a shock, we're just going to keep moving away. Now what we're going to imagine is a slightly more complex model, which is where we have an S-shaped price dynamics curve. So what this one is designed to show us is how we can both get a sort of bit of a boom and a bit of a bust. So let's imagine that we are at point A, and you can see it's labeled as a tipping point, an unstable equilibrium. Because if we imagine that we're at point A, and then there's some shock which pushes the price over here. So what's going to happen? Well, we go up to our price dynamics curve to tell us what the price is going to be tomorrow. And you can see that this price dynamics curve is above the kind of unchanged price. So if we got up to this price, then that level there would show us staying at that price. But our price dynamics curve shows us that we actually go above that price. We're going to push even further away. So we're going to push further to the right. And this is going to keep on happening, right? If we're here, then our price dynamics curve shows us we're going to go even further away from our equilibrium until we reach this point, right? There is another equilibrium up here. And so this is the sort of process of a boom where we go from like the kind of current level to then shooting up and up and up and up until we reach a sort of higher upper bound where things kind of come back to equilibrium again. And the other side shows us kind of precisely the same thing, but with falling prices. So if we get a shock that pushes us this way to like a lower price level than the equilibrium at A, then our price dynamics curve shows us that our price in the next period is going to be even lower, right? And so we're going to be maybe over here. And then the price dynamics curve shows us that that's going to lead to an even lower price the next day. And so price keeps falling and falling and falling until we get to point C, where there is an equilibrium again. And so this is sort of the lower bound, right? Where prices have fallen, 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 but then hit this kind of lower level and they stop falling. So this shows us how in housing we could get like a bit of a boom, a bit of a bust, but maybe we'll kind of stick between this upper and lower bound. We'll never see kind of massive variations, except if something happens which actually changes the price dynamics curve and changes it. And I'm going to cheat a little bit here. Yeah, sorry, just cheating a little bit to get where I want to be. So what could happen is that people start to lose faith in the value of housing, and that potentially could shift the whole price dynamics curve downwards. That people think like whatever the price is today, the price tomorrow is definitely going to be lower. So if we imagine that we start after some boom, right, that we've had kind of years and years of like increasing house prices and we've got to this higher upper bound, but then suddenly there's like a loss of faith. So what does this new price dynamics curve show us? Well, that if this is where we are today, then tomorrow we are going to be at a lower price, right? So I say a lower price here, and then that's going to lead to an even lower price tomorrow. But here's the key thing. With this new price dynamics curve, this one isn't crossing our unchanged kind of equilibrium line anymore. It's only crossing at one place, which is all the way down here. And so what this shows us is prices started at this level B, and once they start to fall, they're just going to keep on falling and falling and falling and falling until we actually get down to this new really low level. And this illustrates kind of one way of thinking about how there could be like genuinely like a crash, right? Not just sort of a bust, but like a proper crash in the value of housing. Okay, so that's one way of kind of imagining what happened during or to kind of kick off the financial crisis, is this is what started happening in the housing market. So let's now return to, I suppose, thinking about what happened in the financial crisis and how did it get resolved. So before I do, again, just going to take a quick pause. Okay, so to kind of finish off, we're going to look at some of the data from a kind of government, from a macroeconomic, and maybe from a household perspective, and then talk about the role of banks in this financial crisis. So looking at this macroeconomic data really does support the story that we've told. Why do I say that? Well, if we look at what's happening in sort of like mid 2006 to late 2007, we see consumption, residential investment, government consumption, investment, exports, these things are all increasing, but residential investment has dropped, right? So investment in, say, the building of new houses has started to drop. And why would that happen? Because there's less demand, because now more people with mortgages are defaulting, can't afford to buy new houses. And so that really kind of goes along with this story of the housing bust being the beginning of this crisis. And then we see we're in the crisis now, and consumption has fallen, non-residential investment has fallen, and we've got even further decreases in residential investment. So this sort of indicates now that consumers, businesses, they've all started to lose confidence. They've started to potentially save more, certainly decrease amounts of investment. But we see the government response here, right? We see government consumption and investment go up, right? So that indicates the government's trying to step in to boost aggregate demand to kind of instigate a bit of a recovery. And then when we fast forward a little bit, we get indications that that did happen. So interestingly, government consumption actually went like slightly negative during this period of time, but the impact of maybe this government stimulus, this fiscal stimulus and monetary stimulus has led to a big increase in consumption, right? And that's a big indication, therefore, that aggregate demand has gone positive again. We even see some non-residential investment, so firms have regained confidence. And in terms of residential investment, basically nothing. But this seems to suggest that the government stimulus in the US certainly worked in terms of increasing aggregate demand and putting an end to the crisis. And we can also think about what happened at a household level using this idea of kind of broad wealth again. So here we're looking at 1980s. And so we've got exactly the total broad wealth equal to the target broad wealth. So everything kind of in equilibrium, in balance. And then maybe into the 1990s and 2006, so into this great moderation period, we actually might see an increase in the target level of wealth. Why? Because people are starting to see, well, actually, interesting. If we look at quick, like a direct comparison, it's not about future earnings kind of going up or financial wealth going up, but home equity increasing, right? The value of homes going up, and that increased the target wealth. But then when this housing boom, housing bust happened and the kind of financial crisis happened, then what do we see? Value of home equity drastically drops. Financial wealth drops a bit, and then expectations of future employment because of seeing higher levels of unemployment and just like general lack of confidence, that falls as well. And so we see a gap between the total wealth, the total broad wealth, and the target broad wealth. And so this would indicate that the average household is now going to try and recover that wealth by decreasing consumption and saving. And that matches up quite well with what we saw here. We see consumption go negative, a decrease, and that matches up with those two pictures. So what about the role that banks played in this? Well, as we saw, they became much more leveraged because they were buying more of these financial assets based on mortgages. So they were putting themselves in a position where they were at a higher risk of insolvency. And they were very, very vulnerable to a fall in the value of the financial assets. But there was also this liquidity problem because commercial banks and investment banks became quite nervous about lending to each other. And why did they become nervous about lending to each other? Because they were not sure that maybe the bank they were lending to would be able to pay them back tomorrow, because maybe that bank would go bankrupt because they had such a high stake in these financial assets. And so the mechanism that banks use, the money market, where they lend to each other to make sure they can meet their liquidity requirements on a day-to-day basis, this started to really kind of dry up because banks were not willing to lend to each other. And this is what we mean by, or what was meant by the credit crunch, that banks were not able to get hold of liquidity to keep day-to-day operations going because of the nervousness banks had in lending to each other. There was also a fire sale of the assets. So a fire sale as in, the value of assets, the financial assets that banks had were falling. And so what did they do? They wanted to get rid of them as fast as possible. So they accepted really low prices, but that made people even more nervous about the value of those financial assets. And then like the prices just kept falling and falling and falling. So falling assets, increased liquidity risk, falling value of the assets means getting closer and closer to insolvency. And so the only real kind of, I suppose, solution to this was for the government to step in. And the government stepped in. We use the term bailing out the banks. So the central banks around the world essentially purchased lots of these sort of toxic financial assets, got them off of banks' balance sheets, which was very, very helpful. There was also, big fiscal stimulus to boost aggregate demand, and the, extra and then quantitative easing, which meant the central bank was pumping more sort of money into the money supply. All of this put an end to the credit crunch. Banks became more willing to lend to each other. And so it was essentially government stepping in and implementing fiscal stimulus and monetary stimulus, but also really buying up these toxic financial assets. Those were the keys to putting an end to the financial crisis. So that is a good, I think, summary of how we can use the models we've seen to think about a very long period of economic history. And that is the end of this video for Unit 17. As always, I hope that it has helped, and I will leave it there.